How's it going, YouTube? My name is Christian with Plan Your Federal Retirement, back with another video with our All About FERS series. Today, I'm going to be talking about taxes and in particular, the taxation of your FERS pension. And so today I wanted to talk about the actual amount that is going to get taxed, but then also looking at the marginal tax brackets to see kind of where we might fit in the marginal tax brackets, and then some tips to be thinking about for some tax planning purposes. We're going to exclusively talk about federal income taxation of your FERS pension. We're not going to be touching state income taxes. I know our viewers that we have, they're in all different states, and different states tax or might not tax your FERS pension. So we got to make sure, depending on what state you're in, if it's going to be taxing your FERS pension or not. And I'll leave that on you to decide and if that applies to you. So what I wanted to do was talk a little bit about some history when it comes to the FERS and prior to FERS, the CSRS pension systems. So in the past in CSRS, we were contributing more into that retirement system, and our pension was a higher amount because we weren't paying into Social Security. So the contributions into CSRS were at a higher amount than what they are now in FERS, but in FERS, we get Social Security. So it's kind of a little bit of a trade-off there. What we see is, depending on when you were hired under FERS, if you were hired before 2013, then you're paying a certain amount. I think it's 0.8% of your base pay goes into FERS, to the FERS pension, or just FERS in general, sorry. And then I believe between 2013 and 2014, if you were hired in that time frame, you're paying 3.3%. And then after 2014, you're paying 4.4% for FERS. The benefits are all the same. It's just the amount that you're paying into it is greater depending on when you're hired. And that was called FERS Ray, that started in 2013 through that calendar year. And then in 2014, it's called FERS Fray, revised annuity employee, further revised annuity employee. So anyway, why I say that is those contributions into FERS are post-tax. We're already paying taxes on those dollars that we're paying into FERS. When it's time to turn on our pension and receive the pension, part of it, it's amortized for our life expectancy, how much we've put in, that we wouldn't be paying taxes anymore. In years past, the amount that we paid into the pension system was, for the first year or two, paid out to us tax-free because we were getting our return of how much we put in for the first couple of years. So that first couple of years wasn't taxed. Now it's based off of an amortization schedule of your life expectancy, kind of a fancy way of saying somewhere between 2 to 5% of your pension isn't going to be taxed under FERS. So again, between 95 to 98% of your pension, your FERS pension, will be taxable to you. And so just wanted to note that. When it comes to the gross amount, let's say our pension amount is $3,000. That's the taxable amount, or the gross taxable amount. We also have those deductions that come from it, like FEHB premiums, possibly some life insurance premiums, maybe long-term care premiums. We also see survivor benefits as well. All of the health insurance is paid post-tax. That's one of the changes, at least with your health insurance, is when you retire, it's no longer pre-tax, but it's post-tax. But the survivor benefit is a tax-free deduction. So if we use that example where we have a $3,000 pension and we had the full survivor benefit, that would be a 10% cost, so $300. The taxable amount of your pension in that example, 3,000 minus 300, would be $2,700 would be the taxable amount of that pension. Again, we then have to subtract out the insurance premiums and taxes from that as well to get our net number. So what I want to do now is talk about the marginal taxes and looking at a chart to see where we might fall, because I know that your pension that you receive is more than likely not going to be your sole source of income for you in retirement. And working with lots of different clients, depending on if you're single or if you're married, there's going to be other sources. Maybe you're going to have, eventually you'll have Social Security income. Maybe you have a spouse that's working. Maybe you'll be working at a different job. TSP distributions, IRA distributions, right? All of those other sources of income will add up and will get pooled together to determine what our gross income is. And then Once we have our gross income, then we subtract out the deductions. And in this case, the standard deduction we'll use as an example. If we go to this chart here, let's just say if we added up the pension, the IRA distributions, the taxable amount of Social Security, we had $100,000 of gross income minus the standard deduction. I'm going to round and say it's 30,000. Then our taxable amount would be 70,000. So let's actually see what this standard deduction looks like. For 2024, it's $14,600 if we're single for the standard deduction. If we're married, it's $29,200 in 2024 is the standard deduction. I just rounded and said 30 just for a quick, easy math here. There's an additional standard deduction if we're over 65 or blind. For single, it's $1,550, and if we're married, it's $1,950. Again, gross income minus the deduction, in this case, the standard deduction, equals the taxable income. Then we would take this and come up here to determine the taxable income based on our marginal tax bracket that we have. This chart is helpful. I like it because it compares the prior year, 2023, with 2024. And it also looks at, the difference between married, filing joint, and qualifying widower versus single. And then it tells you what your marginal tax bracket is for 2023, 24, and then also 2026. And 2026 is unique because in 2026, that's when the Tax Cuts and Jobs Act would have just ended the prior year, 2025. So the marginal tax brackets go up in 2026, and this chart shows that. So let's just say we're looking at this marginal tax bracket at married, and we notice the first tax bracket, the first dollars between $0 in 2024 to $23,200, that's taxed at 10%. The first $23,200, if you're married filing joint in 2024, is going to be taxed at 10%. The next dollars between $23,200 and $94,300 is going to be taxed at 12%. If we make above that based on our taxable income, so between $94,300 and $201,050 in 2024 is going to be taxed at 22% if we are married filing joint. What we notice in 2026 is the first tax bracket stays the same, 10%. Then the next one goes from 12 to 15%. And then the next one goes from 22 to 25%. And we also notice that it happens again at the next one, 24 to 28%. So we know in just a couple years now in 2026 that taxes will be going up. So that's one thing to note. Let's also look at single. Basically, these numbers are pretty much cut in half. Between $0 and $11,600 is taxed at 10%. But the next amount between $11,600, $47,150 is taxed at 12. $47,150 to $100 is taxed at 22, right, and so on. And what we're noticing is when it comes to the marginal tax bracket, not every dollar is taxed at your marginal tax bracket. And I think a lot of times people get that confused. It's stepped up depending on the tax bracket that you're in. And so what a lot of times people think is if I'm in, let's say, the 22%, then all of my income is going to be taxed at 22%. It's just not the case. The first $23,200 is going to be taxed at 10%. Then the next amount between that 23 to 94 is going to be taxed at 12. And let's say we had 100,000. Well, only the extra, $6,000 above this, 94,000, is going to be taxed at 22%. So there's a difference between our marginal bracket and what is known as our effective bracket or our average bracket or average tax rate. So just wanted to note that. But if we used our example here, we had 100,000 of gross income, $30,000 standard deduction, 70,000 of taxable income. We'd say, okay, where do we fall? Well, we would fall in that 12% bracket because we have 70, and that's between these two numbers here. So going back to your first pension, right, we have to understand that not 100% of it is going to be taxable because we know that we're going to get a return of how much we've paid into it, essentially amortized based off our life expectancy. We know that the survivor benefit isn't taxable to us. But then we also know that we're going to have other sources of income coming in, and depending on what those amounts equal will obviously affect the marginal bracket that you're in. And so if our marginal bracket is, right on the cusp of one of these numbers, and then we do other things, maybe we sell some investment where there was a high capital gains, or maybe we do a Roth conversion, this could drastically affect your tax plan. So we got to be mindful of how these things work. So hopefully this was helpful in going through the taxes. If you have more questions related to this, feel free to leave your question below. Make sure you're subscribed to our YouTube channel. Make sure you go to our website at planyourfederalretirement.com for more great resources. And of course, until next time, happy planning.